Hi, and welcome to BizTech's Inside Trading Show. Now, this show is all about trading. Every week, we discuss what trading is all about and what are the required habits for you to become a successful trader. We also share trading ideas and themes, all of which are designed to help you make money. Now, with me is my co host, Jeffrey Halley, and our regular guest, Leung, founder and CIO of TrackRecord Trading Academy. Gentlemen, great to have you on the show.
Hey, it's good to be back. Let's talk about trading.
Now, first of all, as always with this show, we start with a quote. And the quote for today, and V, you go ahead.
Yeah, it's from Paul Tudor Jones. He's quite simply said that if you have a losing position that is making you uncomfortable, and the solution is very simple. Some people try to make it very complex, right? Trying to figure out what to do. Actually, the solution is very simple. Just get out. And I think it's something that even really experienced traders need to be reminded of repeatedly throughout their careers. Sometimes it's just not about trying to be right or trying to get things right all the time. If it doesn't feel good, just get out and then find something else to do, right? There's lots of things to do in this world. Sometimes it's just a matter of just getting out of a position that's losing you money or having a view that it's against what market is doing.
Okay, now
Yeah.
both of you ran trading desks across the APAC region. So V, you did it at Morgan Stanley, if I remember correctly, and Jeff, you did it at Saxo. Um, is this really an overarching theme that you've done, throughout your career?
I couldn't agree more. We used to say the first cut is the cheapest, and which sort of sums up what that statement said before. So risk management is everything in trading. It's people get blinkers on about making huge profits, but actually, I've always believed that trading is about managing your losses.
Now, that's an interesting thought, managing your losses as opposed. And you also said something about, as we were talking offline, really, Jeff, you mentioned that 7 out of 10 trades, it doesn't matter if you lose money as long as they're the small amounts of money that you lose and not the big trades. Tell us about that.
Well, it all comes down to how you manage your risk positions and your losses. So, in my mind, traders get focused, or they can only think that they're going to win every single time, and that's not how life is. You're better to lose 7 times out of 10, but only lose a minimal amount by aggressive risk management, and then run those other 3 profitable trades for a long way and make good returns on them. And to me, that is really what trading comes down to, not trying to be a winner 100% of the time, because it just doesn't happen.
How about you, V? What are your thoughts on this, given
I
your
think
experience?
Jeff is absolutely right. It reminds me of the first trading principle. I guess when I started my career in London, I was just a young guy in London starting out. I had no clue what trading was, and my boss came to me and says, "You know what's the secret of trading?" And I was waiting for some mind blowing advice, and all he said to me was like, "Many losses, but very few gains." So it's exactly as Jeff said. It's about taking all the small losses when you're wrong. When you're wrong, you limit your losses. But for the few times that you're right, and it's not difficult to be right for a few times in your life, but for a few times that you're right and you let your profits run, you make a lot of money compared to the losses that you tend to take. And that pretty much sums up a successful trading career and investment advice for any aspiring traders, I think.
Okay, so now let's take that all down to how are we going to react to what's happening in markets today. We've had volatile markets in January so far. Let's talk about expectations around the Fed. We ended the year with the thoughts around the Fed making multiple rate cuts throughout the year, but that's kind of changed. Tell us about the expectations and where you see things heading. We'll start with you, V.
Well, so we ended the year with the Fed final meeting of the year telling us that they project 75 basis points of cuts this year, which means 3 times they're cutting 25 basis points, 0.25% each cut by the end of the year. But the market in general is the one that makes or breaks us, right? They disbelieve the Fed. They have been disbelieving the Fed for some time. Current market pricing is now for 140 basis points of cuts by the end of this year. So that's pretty much almost twice as much as what the Fed has told us officially in their projections, and even as recent as on Wednesday, last week, the Fed was saying. Fed official said that he brought his first interest rate cut projections forward from fourth quarter of 2024 to third quarter, but that is still way after where the market prices for the first cut. The market is expecting a cut in as early as March, right? So market expectations is way ahead of the Fed, and Fed is telling us they do foresee some cuts, but it's not anytime soon. But that's where we are right now. And I think as an extension to that, I think it shows very much in the market prices as well. I think what the market underestimates is if you watch even the financial press and financial media, they're not talking about a bull market, right? But we have been in a bull market for some time now. We've seen cryptos going up. We've seen NASDAQ breaking all-time highs, S&P breaking all-time highs, Dow Jones breaking all-time highs very recently. So I think we are still stuck in a very uncomfortable, many people are still stuck in a very uncomfortable position of thinking that the Fed is wrong, they're not going to cut, or they're just only going to cut 3 times. I think the Fed is wrong in that they will be cutting soon, and they will be cutting when they start cutting. They'll be cutting very rapidly. Yeah.
And this brings to mind, as you were mentioning this, how we repeatedly said that we wouldn't recognize, and you had called it last year, that the start of the bull market is something we wouldn't recognize, but all the signs are actually there. So I'm just referring the audience back to some of our older shows, and what we've called is actually correct. But I want to now get Jeff's opinion on what's happening today and where he sees the direction moving forward.
Well, I think this week's been characterized by some wobbles, so to speak, whipsaw price action. The market's very, very heavily invested in this Fed easing trade. Equities are higher, US dollar is lower, bonds prices have gone up, yields have gone down. Precious metals and cryptos have been very well supported as well. This week, after some comments and some data points that came out, we've seen some unwinding of that general trade. We saw the US dollar, it's had a great week, and we saw yields rise as well, and precious metals, particularly gold and silver, got a bit of a thumping. Surprisingly, cryptos were resilient. Coming into the end of this week, though, we've started seeing equity markets take back some of those initial losses and start moving higher again. I suspect that the market feels quite confident in out-predicting the Fed, so to speak, because the Fed got transitory inflation so wrong. So quid pro quo, if they got that wrong, it's quite logical to believe that they may get when to ease wrong as well. My inclination is that we could see some hefty reversals or corrections still, particularly if personal consumption data next week in the States surprises to the upside. But I think, as V is probably going to allude to, the market can stay irrational longer than you can stay solvent, and you have to respect momentum. And I believe, looking around at the market right now, although I do feel a few nerves, there does seem to be plenty of momentum to this trade.
Now, I want to ask then, just before we end this conversation, we're coming into the Fed blackout period before the next rate decision. We've got 2 weeks. As an investor, trader, what should we be watching out for? What sort of trades should we be doing?
Well, I'll take this. I think So as Jeff pointed out, the data point that is important before the Fed meets is the PCE price index, which is the Fed's preferred measure of inflation. It's very important to them, and if we should see a surprise to the upside, then we could see some the market taking back some of the expectations of aggressive interest rate cuts, right, going forward. But I think the for an investor, as we've always been talking about, is that you don't really need to be trading all the time. You just have to extend your time horizons and look to what's important, right? And as Jeff also pointed out, what he said about the Fed being wrong about transitory inflation reminds me again of an episode that we did last year, Brian. So it's kind of like a love fest today. We are patting each other on the back.
We're always 100% correct in hindsight, aren't we?
Yeah. So what we said then, I think, as I recall, is that the Fed was wrong about inflation being transitory, and I believe now that they are going to be wrong about disinflation being transitory. So this is the argument right now. They think interest rates will stay higher for longer. They will not have to cut aggressively because they think the disinflation process is transitory. It's not going to be persistent. But we did point it out quite early on that they will be on hold. They will be talking about cuts. And I think when this year, by the end, so we are starting this year and we are talking about what we expect going forward. I think by the end of this year, we'll be talking about deflation being a risk, right? I think as you also pointed out, Brian, we talk about AI and how it's going to make sweeping changes in our lives. I think we're about to see AI increase productivity and introduce and cause a sweeping this inflationary spiral in wages, in high-end wages, in high wages jobs going forward as well. I think we'll see that increase in productivity across many different sectors.
I want to ask you about this. I want to stop you here at the moment because you brought something over that I think, and I want to have a contrarian view on disinflation. Now, the key thing that's happened now is the following: at the start of the year, which has thrown your thesis off, is basically the Red Sea impact. So what's happened then is because of the massive increase in freight rates in the short run now. We don't know how long that's going to be, but basically Jeff and I did a show with another analyst, Jessica, from Moomoo earlier in the week, and she talked about how insurance rates for freight are now at 1% of cargo. And that's going to then trickle down into inflationary pressures across goods and services. And of course, then any sort of supply chain disruption. So I want to just throw a spanner in the works there in terms of that could be the way, that could be the catalyst for the prevention of deflation.
Yeah, so I think that's a good point. Of course, I cannot be an oracle of what happens in the Red Sea.
You are not the oracle,
whatever, right? So that's the caveat, right? That my central thesis revolves around the world being a safe place, right? Of course, we do not live in a safe place, and it's very interesting that you bring this up. So there are various kinds of causes of inflation, but I think the inflation that is caused by supply chain constrictions and caused by war, geopolitical worries, this is not something that should be addressed with monetary policy. Fed should not hike interest rates because there's a war going on somewhere else, right? In fact, they should be worried about the economy because there's a war going on somewhere else and fuel has become more expensive. But of course, that could be a massive, a huge episode talking about this going forward. But I think, yes, it's very important to realize in the shorter term, we could see inflation spike because of this. But assuming our policymakers are rational, they will try to look past that and see the underlying causes and could imagine that, in fact, that could be recessionary, right? Because if inflation prices, fuel prices goes up, freight prices go up, trade is grinding to a halt. There's really no reason for them to be thinking they should be hiking interest rates in response. That's one thing. But also, you bring up a very good point. I think Jeff said as well, the markets can stay irrational longer than we are solvent. But it is not a matter of whether it's irrational or not, right? But right now, the Fed has paused. The Fed is pointed out to us in December they are going to talk about rate cuts in January, and I think a lot of the bearishness is caused by people being conditioned to the fact that stock prices has been going down for some time now, and there's no logical reason why it should be going up anymore. But in fact, it is going up, right? But as we have also pointed out several times, bull markets are formed when markets are climbing the wall of worry. So the more worries that there are in this world, the more and yet asset prices are going up. It is very, very convincing that the markets are not involved. It's not over invested, and chances are every dip will be bought because we are at the beginning of this year, and if stock starts to continue to make all-time highs, people will start to be getting the FOMO, right? Fear of missing out. Asset managers, most asset managers would have underperformed the index last year because everybody was bearish, right? Every talking head on TV was so bearish, right? So
Yes.
no one in their right mind went over invested, right? So I think this is an interesting note that we are starting out this way. The markets, Nasdaq is at all-time highs, and S&P is less than 1% away from all-time highs. Of course, as of recording session, by the time this gets out, it may have already gone different ways. But I think what is important to remember is that yes, there are so many things that could throw this story into a different path. But for now, as far as we know, a lot of reasons for the stocks to go down, for the markets to sell off, but it's not selling off, and that's the best reason to be invested.
So respect the momentum. Take your view out to a medium-term view and respect the directional momentum.
Yes, correct, and absolutely, it goes back to our initial quote from Paul Tudor Jones. If you're uncomfortable, you will be uncomfortable now. If you're short the market, if you're underinvested, then just get to the other side of it, right? In the trending market, there's only two things to do, right? It's either you're with the trend or you just get out of the way, right? You don't try to fight the trend, and that's the surest way to lose money as far as I can, as far as I know so far. Yeah.
On that sobering piece of advice, I think we're going to end it. So don't swim against the tide, follow the trend. That's something I'm going to keep in mind. Gentlemen, thank you very much for coming on the show. That's it for this week's Inside Trading Show. V, thank you very much.
Thank you.
We've been speaking to Phan Leung, founder and CIO of TrackRecord Trading Academy. And this has been BizTech's Inside Trading Show. I'm Brian Fernandez.
And I'm Jeffery Halley.
And this show will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.